Cruise ship operator Carnival is one of the most volatile stocks on the market. Shares are up 122% year to date, yet the stock is still down 66% from its 2019 peak. That seems a bit strange. After all, travel demand has roared back following the pandemic, and Carnival is posting record numbers. Revenue has doubled this year to 20 billion, and occupancy rate in the third quarter was 109%. That's only a little bit below the 113% print in the third quarter of 2019. Clearly, the pandemic didn't put people off cruising, and this looks as good a business as it was 4 years ago. So why has the stock fallen by 2/3? The obvious answer is that the pandemic has had a staggering impact on Carnival's financial position. Free cash flow in 2020 was negative $10 billion, and over the next 2 years the company burned through another $14 billion. Those losses had to get funded by the issuance of both stock and debt. Otherwise, the company would have faced bankruptcy. At the end of 2019, Carnival had 688 million shares outstanding and about $10 billion of debt. Today, shares outstanding has more than doubled to 1.4 billion and debt has more than tripled to 30 billion. So while Carnival's stock is down about 66% since the pandemic, the company's enterprise value, which includes debt and cash, has actually increased by about 15% to 54 billion. That pile of debt means Carnival's balance sheet is dangerously levered at nearly 10 times EBITDA, and that could become a problem, especially if travel demand is near a peak. Right now, consumers are paying up for travel, but airlines fell last quarter on slowing growth, and it wouldn't be stunning if cruise lines did the same. Carnival could get some help from oil prices, as the company spends a significant amount on fuel, but declining oil prices may also be due to a weakening economy, and interest expense on Carnival's large debt balance is increasing due to higher interest rates. Meanwhile, free cash flow and net income on a trailing 12-month basis are still negative. This means Carnival is going to find it difficult to pay down any significant amount of its debt. In this context, perhaps the most surprising thing isn't that Carnival stock is down 66%, it's that the stock has rallied so strongly over the last few months. Right now, about 11% of Carnival shares are sold short, and it's not hard to see why. With so much debt on the balance sheet, I'd give the stock a negative rating, but these are my personal opinions, not financial advice, and I've got no position in Carnival stock. Thank you for watching.